Hi everyone, Leah the trader here from Tmad, Trading Mindset and Data. So today I want to quickly talk about a new addition to our Tmad app. We added EXPIRY to our app. It's an excellent tool for trading and also investing because you can distinguish real movement from noise and see allocation of smart money. So right here, when you click on an ETF or a stock, you have EXPIRY strike, right? This one we have been using for a very long time. You know where's the biggest open interest on certain strike on options, as well as you can see the Jack's wall, call wall is right here, and put wall. All right, 705 put wall. So this one you guys understand, but let's go to the EXPIRY because that's what this video is going to be about. So when looking at EXPIRY, it's helpful to break it down by time frame rather than just the total number, right? So here is a simple way to think about it. The short term, next 1 month, when you see on the option chain, like here, June 26, July, June 30, July 2nd, and so on and so far. This is mostly what market makers are doing. It's a forced hedging because when price moves up, they have to adjust their position quickly to stay neutral, up or down, right? So this creates a lot of short-term noise and then can push the market around even if there's no real conviction behind the move. That's why a lot of the option flow apps are very noisy because they're showing you all this hedging. People then think, oh yeah, we're going up. No, it's just hedging, and that's why a lot of people lose money with this kind of apps. So be careful with that. Midterm, 3 to 6 months, you can now see what hedge funds are doing. It's speculative money, right? These players are usually taking directional bets. So this time frame gives you a better read on where the market or the stock price might be heading over the next few months. So you can start playing with those when it comes to your positioning. And long term is 6 months and longer, including leaps. Leaps are option contracts that expire longer than 12 months, right? This reflects what big institutions are actually committed to. So these positions tend to be more stable and act as a real foundation for the market. So you want to split these checks by expiry into buckets, and you can then separate short-term hedging noise from stronger, more meaningful positioning. So it helps you to see who is being forced to act versus who is actually betting on conviction. Right, so here we see QQQ. Short-term QQQ looks very negative into next week, right? So it so far looks like the market is going to go lower. When we look at the longer term, also we see more put hedging. So there is a little bit of negativity going into QQQ. When we look at Tesla, for example, let's look at Tesla. So here we have EXPIRY, of course, the 8 at the money strike 380 is the biggest. That's usually the case. Once we overcome it, we can go higher. But let's look at the EXPIRY because I really want to explain to you how to use this. So short term, this week into 4th of July is the biggest bar on the chart. It's very large positive checks here, right? We see 160 million versus 90 million. This means that market makers are long gamma in a very near term. They will likely buy the dips and sell rips aggressively this week. It acts as a stabilizing force and can make big moves harder to sustain. So Tesla is probably not going to make a giant move this week. Then when you go later June, July, you see that the negative gamma around July 17 here is building. So if the price starts moving hard into that expiry, moves could become more violent. So longer term is not providing any directional bias, right? It looks pretty balanced there. So simple terms means the chart says near-term support is strong, but by mid-July, watch for volatility, okay? The big positive gamma this week is currently the dominant force, and then we play it as we go. And then when you look at August and later on in the year, there is no major negative gamma clusters and bars are getting much smaller. This shows that big institutional positioning further is relatively balanced, so not heavily one-sided. Means that Tesla might be actually just chopping around for the rest of this year, right? So this is a very interesting chart to see if you want to position, especially with options. If you don't see there is anything specific happening in the long term and you want to buy calls, it might be counterproductive because your theta might just kill you at some point. So you kind of want to see if something will be shaping up in the long term when you're buying leaps. Right, so that's just a quick rundown through what the JEX by expiry means. I hope you enjoyed. Please ask if you have any questions, and we'll be back soon. Bye bye.